Quick disclaimer, anything we discuss on this video, on this channel, it's not a financial advice for you to buy, hold, or sell any shares, ETF, or any investments. Please do consult your financial advisor before you make any investment into the stock market. Let's move on to the video now. Biggie, the 31% yield ETF. You have probably seen it on Reddit or YouTube. So if you click on this video, you either have Biggie ETF or you're planning to buy one. Canadian ETF paying 31% yield, monthly distribution twice a month. Sounds too good to be true, right? I spent more than 40 hours analyzing Biggie, the ETF, the Evolve US Equity UltraYield ETF. And what I found will shock you. Some investors are making $3,800 on a $10,000 investment. Others are losing 50% in crashes. So today we're breaking down the math, the risk, and exactly who should and should not buy this fund. Welcome back to the channel. If you're new here, I'm diving deep into investment that sounds too good to be true, and today's no exceptions. And trust me, this thing is one of the wildest income product in Canada right now. We are analyzing Biggie with the real data, real scenario, real numbers. By the end of this video, you will understand how Biggie actually generates that 30% yield, what happens to your money in the bull market, bear market, full crashes, how the drip can turn the disaster into a win, whether the leverage is friend or your enemy, and whether this ETF is a smart income play or a ticking bomb. And most importantly, by the end of this video, you'll know exactly whether Biggie belongs to your portfolio or not. Is this fund right for your portfolio or not? Let's touch the basic. But before we move on, I just want to request you guys, please hit the like button. Subscribe to the channel if you haven't done yet. It does not cost you anything. I would really appreciate that if you can do that right now. Don't forget to press the bell icon. Let's move on to the research now. So let's get into it. Before I switch my screen 40 hours, couple of days to put this presentation together, there was a lot of calculations, a lot of factors has to be considered. So if there's any mistakes, please do your own due diligence, do your own calculations. Make sure you check everything by yourself. This is just my representation. Another thing is there are a lot of notes. So you may want to pause and read the notes and continue with the video. You may have to watch it a few times if you want to go through everything. I just don't want to make this video very long. So I would probably try to make it short, but you have all the information on the screen. You could always take screenshots, go through all the notes, go through all the calculations that I've done. And also another thing, personally, I'm invested in Biggie. I have 5,000 shares at the average price of $24.01. And I've invested $120,050 into it. But in this video, we're going to take an example of investment of $10,000 in the different type of market scenarios. So let's move on to the first screen. So here we are at Biggie's presentation. So let's move on to chapter one. So chapter one is what exactly is Biggie? The Evolve US Equity UltraYield ETFs, Canadian listed fund by Evolve ETFs, a Toronto-based issuer known for their thematic income focus products. Big main objective is maximizing the monthly income from US large cap equity using covered call, and 33% on top of that. Distributions are twice a month at 0.3125 per share in Canadian, based on the price right now, annualizing to about 38.5% yield at the current, annualizing to 38.5% at the current price, which is, again, here's the information right now. Biggie is listed in TSX. Current price is $19.47 when I started this research. Yield is 38.5%, as we just discussed. All this information we've already gone through. So let's discuss how this strategy works. Actually, Biggie holds diversified portfolio of US large cap stocks. Mostly they are in S&P 500. Then uses 33% leverage to amplify the position. On top of that, it sells call options against the portfolio, collecting premium that funds the massive monthly distributions. The trade-off for this kind of ETFs are always capped upside. When market surges, Biggie's NAV appreciation is limited by the call option it has sold. You are exchanging growth for income, a deliberate choice for income-focused investors only. For those of you, we're going to come back and say, oh, Biggie is this, Biggie that. So make sure you're watching this video only if you are an income-focused investor. For growth investors, you guys could take those companies and invest them into those. I'm not against the growth investments. In fact, I do have portfolios running growth investments as well as the income investments. So let's move on. So in this scenario, we're going to use $10,000 investment as an example. As per today's price, it's going to buy us 513 shares, generating $3,847.50 yearly distribution before taxes and reinvestment decisions. So let's move on to the chapter 2. In this chapter, we're going to see the injure under the hood S&P 500 historical returns. These returns will help us analyze or also make a judgment on biggie moves. And how was the S&P performing in the last few decades? How was the S&P 500 historical returns? Biggie underlying assets tracks US large cap equities. Effectively, the S&P 500, understanding its history performance is essential for the model biggie behavior, especially under leverage and covered call constraint. So let's move on. So as you could see, this is 25-year scenario. S&P has produced 7.8% per year for last 25 years on an average. 20 years was 9.7, 15 years 13.5, and 10 years 12.8 performance per year, and 5 years 14.2. So now that we know the S&P performance, let's move on to the next scenario. Worst case historical records. Year 2000 to 2002, dot-com burst, S&P fell 49% over 31 months. A leverage fund like Biggie would have faced 65% NAV decline with the distributions at serious risk. Why 65%? Because of the 33% leverage that Biggie uses. Year 2008, global crisis, market dropped 57%, and then Biggie in that scenario would drop to 76%. Option premium collapses and volatility spikes. Third scenario recently happened 2020, COVID crash, S&P dropped by 34% decline in 23 trading days, but recovery came in just 6 months. This is where the covered call fund struggled most. Rapid drop with no time to collect premium. So what this means for Biggie? In this scenario, as I mentioned, we're going to do a 10-year scenario study. S&P 500 has delivered a 10% long-term CAGR, but that average hides devastating drawdowns. Biggie 33% leverage amplifies both gains and losses. The covered call overlay provides a partial cushion by premium income, but cannot prevent NAV erosion in severe bear markets. Now, very important point for any leverage investors, any leverage ETFs, whoever is investing into any of the leverage assets, such as Biggie, historically S&P 500 posted positive returns in 75% of calendar years, roughly 3 out of 4. So this data makes the leverage income strategy viable over long horizon, but sequence of return risk remain critical. This was very important for us to understand how the S&P performed. Based on that performance, we're going to see the Biggie's future projections. So let's move on to the next scenario. So income mechanics, how Biggie generates 31% yield. So we're going to go through that quickly. 3 income streams power Biggie's distributions. First one is stock dividends, covered call premiums, leverage enhanced exposure. Here's a math on 10,000 Canadian investment, 513 shares at $19.47. So first scenario. So first payment, where does it come from? So the shares under Biggie pays roughly 1.5 to 2% dividend itself. We're not talking about covered call dividends. This is the dividend that these companies pay. With the 33% leverage, Biggie's return becomes from 2% to 2.6% from dividend alone. So on $10,000 investment, you are looking at $200 to $260 a year, a small but stable foundation still. So the next one is the covered call premium. Primary income source is covered call premium. The fund sells covered call on 50% of the portfolio, collecting premium as a primary income source. So as of today's price, the overall yield comes up to about 38.5%. So let's move on to the next. So the important factor here is the leverage amplification. So Biggie borrows to invest 33% more than its NAV. This amplifies dividend income, option premium potential, and capital gains, but also magnifies losses and adds borrowing cost from 3 to 5% annually on the leverage portion. So the next part here is the total expense. So MER is another thing we need to consider. MER, which is 0.40% plus the borrowing cost. So the total annual drag comes around anywhere from 0.5 to 0.57% annually. The 31.2 yield is reported after these expenses. Okay, so now that we understand how Biggie generates its yield, so key risks are there. If the underlying portfolio rises sharply, calls are exercised, and Biggie misses upside. NAV stays flat while distribution continue, a pattern called NAV erosion, common in high yield covered call ETFs. I'm pretty sure most of you guys already know, but some of those who are new. Moving on to the next chapter, which is 10-year projection bull market scenario. We model this by investing $10,000. With that, we purchased 513 shares, and assuming that MER stays as 0.40, leverage cost stays at 0.13%, covered call drag reduces the growth by minus 4% annually versus the raw index drip equal to full reinvestment. So this 4% drag is still there because of the underlying expenses. So here you guys could see, I'm not going to go through all the years. I will just skip to year 1, 5, and 10. You guys could have a look at this. If the NAV grows by 5% and in year 5, so the share price has gone to $24.57. And in that case, you will own the units with the drip on 1,009 units. In case the NAV grows to $31 in 5 years, and you have the units of 1,167 units, portfolio with the 5% growth will reach to $24,778. With the 10% growth in NAV in 5 years, your portfolio will be $36,000. And let's jump straight to the year 10. The NAV will grow to 3105. NAV will grow to 3105, and in the case of 10%, 49.59. You could also look at the NAV 15 years, but these calculations are done with 5 and 10 only. So with 5% growth, you will have 1,870 units, and with 10% growth, your unit count will increase to 2,339. Portfolio value with 5% growth for 10 years in a row would be at $58,500. With 10% growth every year, it will be grown to about $116,000. So this was a scenario with 10,000 investment, drip on, considering the underlying expenses as well. So scenario takeaway, 5% growth portfolio grows to 59,000, which is 5.8 times your initial investment, with 21,500 in accumulation distributions collected and reinvested. And the 10%, you guys could see it grows by 12 times, and with 15% your portfolio will grow to about 200,000, and estimated, not fully tabulated above. With 15% growth, your portfolio exceeds 200,000, but covered call drag limits the NAV appreciation relative to the plain S&P 500 index. So let's move on. The drip effect. These projections assume full drip. Without reinvestment, you do collect the 41,000 to 92,000 in cash distributions over 10 years, depending on the scenario, but your portfolio value would remain far lower since you are not compounding. The difference between drip and non-drip widened dramatically in higher growth scenario. That's the power of reinvestment working alongside a higher yield. Now let's flip the script. Bear market and 7 up, 3 down cycle. Earlier in this video, as I explained about S&P produces 7 out of 10 year positive in the market. So we're going to see the scenarios, bear market scenario. Not every decade delivers smooth gains. Here's how Biggie performed when market declines, and why historically 75% positive year rate of S&P 500 is a strategy saving grace. As you could see, you guys could go through all the years. I'm just going to go quickly. Scenario 1, NAV drops 8% every year for 10 years. Shockingly, the final portfolio is at $17,269, and shares are gone up to 2,088 shares. So drip saved the investment here, and you 4x your share count here. So let's move on to the scenario number 2, where the NAV drops by 12% every single year, but the portfolio value in 10 years would be at $15,697, and your share count has gone up to 2,967, almost 3,000 shares, and you 6x the share count here, and drip turns disaster into survival. So even after every year losing 12%, this is what happens, and this is what you have collected. In this scenario, we're considering it continues to pay the same dividends every single year. So drip lifeline in bear market. Notice something remarkable here, right? So as we have discussed all this, NAV falling 8% and the 10,000 portfolio has become 17,000. The share count same thing as we discussed here with 12%. You have more funds now. There's a mathematical beauty about drip in high yield fund, not considering distributions dropped. Distribution income become a weapon against the NAV decline. The yield percentage on your original cost basis actually increases as the share price falls, because you're buying more units with that. But don't forget, most of the time your distribution will also drop. This is the S&P scenario that we discussed in the beginning as well. S&P 500 posts positive returns in 75% of the calendar years, modeling a realistic decade. 7 up years at 10% and 3 down years at 15%. With the Biggie's leverage and covered call drag, net NAV grows over 10 years, 6 to 8% annualized. After leverage boost and the call drag, final portfolio value with the drip on will be at $72,000 to $85,000 on a $10,000 investment, accumulative distributions collected 48,000 to 58,000. Leverage amplifies the 7 good years more than it hurts in the 3 bad years. Net positive over full market cycle. Leverage is a long-term ally when the underlying assets have a positive expected return. S&P 500's 75% win rate makes 33% leverage mathematically favorable over 10 years horizon or 20 years horizons, depending on how long you hold these funds to. This is just an example on an average. Let's move on to the next scenario. This part is very important. We're going to see weighted holdings performance scenario based on the Biggie's top 13 companies. How have they been performing? So chapter 6, holding performance scenario, drip versus non-drip. Weighted holding performance scenario based on the Biggie's top 13 companies. This is the most important decision you make. Full drip on, as you can see, rather than relying on S&P 500 average. This scenario model Biggie's 10-year performance using the actual historical return of its 13 core holdings. Here we are actually seeing what are the underlying assets in Biggie and their historical performance, which is actually going to affect your Biggie's investment accordingly. Biggie's portfolio is heavily concentrated in mega cap tech and growth sector, companies that have dramatically outperformed the broader market over the past decade. Let's look at the real numbers now. You guys could go through all these numbers. I'm not going to go through all of them. As you could see, they're weighted and their 5-year CAGR, their 10-year CAGR, and their 15-year CAGR. Some of the companies they're either new for other reasons the information is missing, but we're basically looking at the 10 years overall. So you guys could go through this. This is very important information to make a decision on your Biggie investment. How are the underlying assets are performing over long period of time? Using available 10 years data for the 6 largest holdings, Meta, Google, Amazon, Nvidia, Microsoft, and Apple, the weighted average 10-year CAGR is approximately 28.4%, nearly 2.4 times the S&P 500's 12.2 years annualized return over the same period. So let's see, 10-year projection holding-based scenario. Here are the assumptions. Full drip, all distributions reinvested. Without reinvestment, final value would be 40 to 50% lower, starting with $10,000, 513 shares at the price of $19.50 or about 47 cents. So conservative class, 20% annualized growth. In 10 years, your value would go up to almost $62,000. So base case scenario, if these companies continue to perform the same way and producing 28.4% average CAGR for 10 years, your portfolio will grow up to $98,450. And if it grows more, let's say if it surpasses the 10-year growth to 35% annually, then your portfolio hypothetically could reach to $157,800 in 10 years. So key insights. Biggest concentration in mega cap tech creates upside in bull market, but also concentrated downside risk. Nvidia alone in this portfolio is almost 10% weighted, has returned 70% annualized over 10 years, pulling the entire portfolio higher. Coinbase, Palantir, Tesla, and Strategy lack long-term data, but represent high volatility and high growth bets. This scenario assumes no covered call and no leverage decay. A real Biggie return will be lower due to these factors. So just make sure we have not considered those drags as we discussed in the beginning, the minus 4% and so on. The S&P 500, 12.2% 10-year return look conservative next to Biggie holding, but concentration risk is real. So the smaller the fund, it could fluctuate very fast. This holding base scenario sits between 7 up and 3 down cycle. So 78K to 85K, and the strong bull case is about 116K, reflecting the reality that Biggie's portfolio is tilted towards the winners, but covered call and the leverage will cap the upside. So don't forget that fact. So let's move on to the worst case scenario now. Worst case scenario, holding scenario, bear market stress test. So what if the tech really reverses? Usually historical worst case decline from year 22 bear market and .com parallel. This scenario model Biggie's 10-year performance if its holding experienced significant downfall. So let's look at the numbers. Worst case holding performance. In this scenario, we see how all these companies have performed in their worst years. One of them is 2022, and you can see all these companies did decline by this percentage here. And worst case scenario, 10-year CAGR is right here, and the base case scenario, 10-year CAGR is right here. So you could see the worst case scenario we're going to use in this study here. 10-year projections, starting with 10,000 Canadian, share count was 513 at $19.47 or 50 cents. Important, these projections assume distribution scale proportionally with the NAV. So they're also decreasing as the NAV drops. So make sure we haven't forgotten about that part here, especially in the bear market scenario. In a true worst scenario, the NAV declines at 50%. So is the distribution. Distribution will also fall from 0.3125 to half of it, right? So don't forget that fact. We have calculated accordingly here. So here we have a severe case scenario. Then NAV in 10 years, if there's zero NAV growth, NAV stays at $10,000. Distribution total would be at $38,475. In the next scenario, worst case scenario, if the weighted CAGR, if 6.2% weighted CAGR, proportionate distribution cuts drip enable, with the 10% growth of all these underlying assets yearly for 10 years, your portfolio will grow up to $93,937 at recovery case scenario with the drip on for sure. Here's some key insights. You guys could go through that, like 22 tech years, wipe out 3 to 5 years of gains of Biggie's investors. MicroStrategy 9.6 weight could turn negative, 75% decline in year 22. Leverage amplifies losses, 40% portfolio decline becomes 52% with the 33 leverage. And cover call provides minimum protection in the crash. They cap upside but don't prevent the downside. Recovery from the worst case takes 7 to 10 years, not 3 to 5 years as in bull market scenario. Diversification is Biggie's weakness as well. 6 of the 13 holdings are mega cap tech with the correlated risk. So compared to the other scenario, worst case scenario will be at 18,000 in 10 years, and in expected 7 up 3 down cycle, your portfolio could grow between $78,000 to $85,000. And the holding base, if you look at the holdings only, your portfolio could go up to about $98,450. And the strong bull market case, as we have seen previously, 116,000 can be expected. Again, the gap between the worst case and the bull case is about 98,000. This is a 5.4 difference. The illustration by Biggie is a high conviction bet on continued tech dominance, not the defensive income plays. Leverage multiply the effects. Biggie 33% cuts both ways. 40% portfolio decline. NAV falls by 52 as we've gone through. You guys could go through all these effects as well. So let's move on to the next scenario. Chapter 8 is the bear market mechanics. How a bear market breaks Biggie, the mechanics of collapse. Biggie 3 income engines, dividend, covered call premium, leverage work beautifully in bull market, but in crash they become the liability. Here's exactly what happens when the market falls by 40%. Using real 2022 data and leverage mechanics scenario setup, starting at a positive $10,000 investment, where all this information we already have it, and market event 40% decline in S&P 500 similar to year 22 timeline, year 1 of the 10 holding period, cascade losses. So let's say if we're back in year 22 and from month 1 to 3 initial crash, portfolio value will drop to 6,000 with the 33 leverage. NAV decline, NAV actually falls 52%, which will bring the portfolio to further down to $4,680. Your 513 shares now worth $4,680 at this price based on this decline here. Unrealized loss of 5,320. And distribution drop proportionately, because we're assuming here the distribution will also drop to 0.146 per share, down by 53%. Monthly income is at $149, down from $320. Accumulated distribution collected 3 months, we have collected almost $450, partially offsetting the unrealized loss of $5,320 loss. As we go along, you guys could see what happened in 22. How would it happen with Biggie if we run through the same scenario from the month 4 to 6? What happened and how would the Biggie will be affected here? Same here with the month 7 and 12. Just go through all the numbers here, and then the year 2 and 3 long-term grind. Market recovers to minus 10% from the peak. Biggie's NAV at minus 15% is, in this scenario, we'll see the market recovers to minus 10% from peak. Obviously, Biggie will drop more to 15%. NAV will come to 8,500. Distribution will become less as well, from 31 cents to about 26 cents per share monthly. Income will get affected accordingly. Accumulating cash will also offset some of the unrealized loss that happened due to the market downs here. Unrealized loss of 1575, which is 15.8%. You are now waiting 2+ years to get back to that minus 15% loss that you have happened here. So same thing with the year 4 and 5. If it takes 4 to 5 years to break even approach, market full recovery to peak, NAV has dropped to minus 5 to 9,500 from $10,000. Distribution has get affected to 29 cents and so on. You could see all the scenario here. Different scenarios, you guys could take the snapshot of pictures. This is 6 to 10 years opportunity cost. The market grow 8% annually from the recovery point. let's say after the crash, market is growing by 8%, and you could see the accumulated cash would be around $43,000. In this case, your NAV will grow to 17,860. Distributions are also grown here because the NAV has grown to 55 cents per share. In this example, you have underperformed by, meanwhile, plain S&P 500 index fund is at $21,000. You have underperformed the S&P 500 by 17.3% less. Your monthly income in this year is $572 per month. So meanwhile, the plain S&P 500 index has grown up to $20,589. You have underperformed by $3,729. That's 17.3% less. Accumulated distribution calculated 10 years total, that's $43,000. You receive more in distribution than your initial loss, but the opportunity cost of the underperformance is $3,729. The covered call illusion. Covered calls sold at peak. Worthless in crash, stock fell below the strike price. Premium collected 15 cents per month times 12. It's $1.80 per share. Loss prevented by covered call, 0. They don't protect in crashes. Upside kept by covered calls, 8% annual during recovery. So net effect of this scenario, yes, you have recovered somewhat everything. You paid for protection you didn't get, and lost upside you needed. Now let's talk about the leverage multiplier in action. 52% NAV decline from 40% portfolio decline. That is 1.3 amplification. 2.5% drag on the net return from 5% borrowing cost increase, 40% income reduction from 30% dividend cuts after the leverage cost, 2x recover time, longer than bull market gains. Real world comparison, year 22 bear market scenario, Biggie's actual year return would be minus 31.99%, NAV decline to 35%, distribution cut to 60%, recovery time would be 18 plus months, leverage cost impact minus 2.5%. In the case of S&P, minus 18.11%, and NAV declined by 18%, and so on. It took 12 months to recover back. The difference is right here. As you could move, psychological toll. In 40% crash, Biggie holder faces 52% NAV decline, 60% distribution, and all that stuff. Covered call worthless, no predictions. Leverage cost rising, paying more to borrow. Covered call worthless, no protection. 4+ years to break even versus 2 to 3 years of plain index. Temptation to sell at bottom, locking in losses. These are the emotional cycles most people they go through. This is why Biggie is not suitable for risk-averse investors or those who might panic sell. So bottom line is here. Biggie's 30% yield and leverage work brilliantly in a bull market. But in a crash, leverage amplifies the losses by 30 to 40%. Covered call provides zero downside protection. Distributions, they collapse when you need income most. Recovery takes twice as long and underperform the plain index fund by 15 to 20% in negative. Biggie is high conviction, high risk bet. It's not a defensive income play. In this slide, we have discussed the worst case scenario as well that everyone should be aware of. So let's move on to the next chapter 9. So the historical crash scenarios. Year 2000, 2008, 2020, stress testing Biggie against historical stress. Worst market crash reveal. All leverage covered call interacts under the extreme conditions. The model of $10,000 investment with full drip throughout each scenario. Let's move on. Year 2000, S&P dropped by 49%. Biggie would drop by 62%. And recovery will take up to 7 years to prior NAV. During a slowdown, grinding decline, covered call premiums provide meaningful cushion. Distribution continue even at the NAV fall. Drip accumulates share aggressively. By year 7, portfolio recovers to 11,500 despite the brutal drawdown accumulative. Distributions are collected over 7 years, $8,400. The key lesson: slow crashes are survivable with the drip. Year 2008 crash, S&P dropped by 57% in 17 months. Biggie estimated NAV would drop to 73% leveraged. Recovery would be in 5 years to prior NAV. Fastest major drawdown in modern history. Premium spike, good for income, but equity losses overwhelmed them. NAV dropped from 19.46 to 5.25. However, the drip turned 10,000 into 1,900 plus the shares. Full recovery to 22,000 by the year 5. Accumulative distributions collected over 5 years is $6,200. Key lesson here: even the worst crash is temporary with the reinvest on. Year 2020 COVID crash, you guys could go through the numbers. Here it took a V-shaped recovery. 2020 crash, S&P dropped by 34% in 23 days. Biggie's estimated NAV would be dropping with the leverage 44%. Recovery 8 months prior to NAV. It will take 8 months for Biggie to recover. V-shaped recovery is Biggie's best case crash scenario. massive volatility spike, option premium enormously, NAV recovered within months, and the fund likely outperformed a plain index fund during the rebound. And final portfolio value has reached to 14,500 after just 2 years. Cumulative distributions collected over 8 months would be 1,100. Key lesson here: fast crashes with the quick recoveries are barely a blend for a drip investor. So this is what it looks like, the market with the $10,000 investment, and where would it go? So year after the crash. So these are the years after the crash. This is the amount that affected the crash. Okay, so let's move on. So our recovery projections assume full drip throughout. Without reinvestment, recovery will take 2 to 3 times longer, and the final values would be significantly lower. The quick note for this slide: the values are estimated based on the S&P 500 historical drawdown adjusted to 33% leverage. Covered call income cushion. Actual Biggie performance would vary based on the option strategy, distribution policy, and market condition at the time, if that ever happens again. Chapter 10 will go down to drip versus cash strategy. What if we do the drip on or off and use some of the cash we're going to discuss in this thing? So chapter 10 is drip versus cash. 3 paths, 3 outcomes. Your distribution reinvestment decision is the single biggest variable in Big 10-year outcome. We compare 3 strategies using the 7-up, 3-down market cycle model on 10,000 initial investment. First one is with a full drip on. As you could see, the snowball effect is in motion. Every distribution reinvested, final portfolio could reach to $78,000 to $85,000. Cash received 0, all reinvested. We did not withdraw anything. Shares accumulated 3,200 to 3,600 shares. Maximum compounding. Every distribution buy more shares, which generate more distributions. By year 10, you are collecting $12,000 a year in distributions alone, nearly 120% yield on your original investment. Best for long-term wealth builders who don't need current income. So let's check the scenario 2. Let's say we use half of it. If we use half the money, half we put it back on the scenario. We're looking at final portfolio would be at $42,000 to $48,000. Cash received $24,000 to $28,000. Shares accumulated about $1,800 to $2,100. Balance income and growth, you collected $2,400 to $2,800 per year in spendable cash, while still compounding half your distributions. Ideal for investor who wants current income but also want their investment to grow over time. A pragmatic middle ground. Let's move into the third scenario. No drip on, you spend everything. No drip on, all distributions are spent. Final portfolio value would go up to $10,000 to $14,000. If NAV only, cash received $48,000 to $58,000. Share accumulated 0 because we did not put back any money. Share accumulated unchanged. So you will live off this income, $3,125 yearly initially, growing with NAV. But without investment, you miss all the compounding. After 10 years, your portfolio value barely moved, but you collected $50,000 plus in cash. Best for retirees who needs the income now. The math is clear. Full drip produces a final portfolio 5 to 6x larger than a no drip over 10 years. If you don't need the income today, the investing is almost always the superior long-term decision, especially with the 31% yield working in your favor. Let's move on to the next scenario here. So this is leverage amplifies, not magic. Okay, in this scenario, we're going to discuss how the leverage affects your investment. It amplifies simply, it's not magic as it says, 31%. Biggie's 33% leverage means every $100 of NAV, it invests 133 in US equity. Here's how that plays out across different market environments and why S&P 500 historically win rate makes leverage a long-term tailwind. Bull market. Leverage is your friend in bull market for sure. If S&P 500 rises by 10%, Biggie's leverage position gained 13.3% before cost and covered call drag. After the 4% call drag, net gain is 9.3%, slightly below the index, but income from the premium more than compensates by distributions. Over a 10 years bull run, 10% annual growth leverage adds an estimate of about 25 to 35% to total portfolio value versus the under leverage equivalent, primarily through the amplified distribution growth that fuels the drip compounding as well. Historical edge. 3 out of 4 years positive. S&P 500 has hosted positive returns in 75% of the calendar year since 1928. Over any rolling 10 years period, the probability of positive return exceeds 94%. And this statistical reality is what makes 33% leverage mathematically sound for long-term holder. The odds are overwhelmingly in your favor. So let's look at the other side of the picture. Bear market. Leverage bites back. We cannot ignore that fact. When S&P falls 20%, Biggie's NAV will drop by 26.6% before any income cushion. The cover call premium provides a partial buffer, typically reduces the net decline by 3 to 6%, but the leverage still amplifies the losses meaningfully. The crucial insight of this slide is leverage risk is asymmetric in the short term, but symmetric in the long term. Short-term drawdowns hurts more with the leverage, but in the bear market, if you see, the crucial insight is the short-term drawdowns hurts more with the leverage, but over full market cycle, the compounding of amplified gain in up years overweights the amplified losses in down years, provided you stay invested and use the drip. Long-term leverage impact scenario. Scenario number one, 10 years bull market, 10% per year grow with no leverage on will be your investment will grow to 28%. And with scenario number one, if market continue to grow 10% every year, your investment could grow no leverage to 28%. And if we see the realistic market 7 up, 3 down, market will still grow to plus 18% with no leverage. 10-year bear market, 8% year in a row, your investment will be at minus 12% with no leverage. This is leverage effect. S&P 500 historical average is plus 2200 versus the no leverage effect. As you see the star here, in persistent bear market, leverage is net negative, but such periods are historically rare and temporary. So you guys have the clear picture of how does the leverage affect us. So final verdict, who should and should not buy Biggie? After analyzing every scenario, stress testing, cash recoveries, model drip strategies, here are the balanced picture of the Evolve US Equity UltraYield ETF fund. The bull case, why Biggie works, 31% yield. 31% yield is among the highest in the covered call ETF strategies. Twice monthly distributions provide consistent cash flow as per the S&P historical positive market. 33% leverage amplifies compounding the income and the distributions. 33% leverage amplifies compounding. Drip transforms NAV decline into the share accumulation opportunity, and low 0.40 MER keeps the cost reasonably for a leveraged option-based strategy. Strong recovery provide in all three historical crashes scenario with the reinvestment, ideal for tax advantage, TFSA, RRSP, when distributions aren't immediately taxed. So let's move on to the next one. Here we have the bear case scenario, very important to understand. Capped upside, covered call, limit the NAV appreciation during the strong bull market. NAV erosion risk, persistent distributions without the proportionate NAV growth can erode the principal over time. Leverage amplify the losses. Tax inefficiency, non-registered account. Interest rate sensitivity, if the interest goes up, the borrowing cost will go up as well, which will affect the yield, which could compress the net yield. Not a total return play. A plain S&P 500 index will outperform Biggie in strong and sustainable market. Currency risk, Canadian hedge and unhedged exposure, added FX volatility for Canadian investors as well. Biggie is not for the growth investors seeking maximum capital appreciation, taxable account holders sensitive to income tax, or anyone who might panic sell during the 30% NAV drawdown. And who should be looking into investments like Biggie? Best for income-focused investors in tax advantage accounts, retirees needing monthly cash flow, and disciplined drip investors with 10 years plus horizon who understand the cap upside trade-off. So finally, 10-year range with full drip, 15,700 worst bear scenario, plus $116,000 strong bull market. Realistically, 7 up, 3 down cycle, 78,000 to 85,000. So a 7.8 to 8.5 return on $10,000 investment. So if this analysis helped you understand Biggie better, smash that like button. And if you haven't subscribed yet, please subscribe to the channel. It does not cost you anything. Please do it right now. And hit the bell icon so you don't miss any of the future videos. And please drop a comment. Are you a team drip or you team cash? I see you in the next one. Bye for now.